to tie that into the effect that that would have on mortgage rates. So if the Fed were to accelerate selling mortgage-backed securities, that would widen the spread between Treasury and MBS and ultimately lead to net, it would lead to higher interest rates. But I think the thinking behind the statement, which I thought was really interesting, Jeff, was is the Fed kind of picking favorites, picking winners and losers too much by expanding their holdings to really anything beyond just treasuries. Another component of that statement was focusing more on a treasury only balance sheet on the Fed. Another component of that was also not playing favorites amongst the term structure within the yield curve. So not trying to push the 10-year down, let's say more than it should go down in order to help, or offset mortgage rates. The whole idea was you want to have a neutral effect on the overall demand for the yield curve. So that means for shorter term securities, you want to buy a similar amount of shorter term securities as you would longer term securities, so that you're not like playing favorites too much with the yield curve. So yeah, it was a very interesting statement. I always appreciate when folks in the Fed issue statements like that publicly so we can get a better understanding of what their thinking is.